Yeah, the essay is in the New York Times is about a question that concerns a lot of regulators and academics, and that is why are fewer and fewer companies choosing to go public? We depend on our public markets for lots of things. In particular, we depend on them to give savers, the average person on the street, a way to participate in the growth of the great American economy. And so we depend on those companies to be a fairly solid representative sample of the economic engines in the country. And so if those markets are shrinking, if fewer and fewer companies are choosing to go public, that's a long-term problem for the country.
Why do you think fewer and fewer companies are choosing to go public right now? I mean, just today we had a CNBC report that said that XAI was in talks to raise even more money, or it did raise $10 billion at a $200 billion valuation. I mean, a $200 billion private company, that's pretty big.
Yeah, it is. It's something we never saw before. I remember when unicorns were considered to be kind of a miracle in the private
the $1
markets.
billion valuation.
Yeah, that wasn't that long ago.
So why is this happening right now?
Well, there have been a lot of theories, but the only one that I think really holds up is the simplest. And that is a private company takes money from outside investors, sometimes venture capital firms, sometimes just, regular people, and it builds a good business. If it's successful, it eventually needs to give those investors a way to get their money back. And it used to be that the way that successful private companies chose to provide liquidity or an exit to their earliest investors was to go public. And then starting about 1990, about the year 2000, 98, 99, it's hard to tell because there was a recession in there. But starting somewhere around then, companies stopped deciding to go public. And they started deciding instead to sell themselves. Both from the standpoint of an investor are fine. Both of them give them their money back and allow them to generate a return on a successful investment. But for the country as a whole, there's some question whether or not both are equally good, especially when you track that decision across 25 years and you wind up with a stock exchange that has only half the number of companies that it did 25 years ago.
Well, Bryce, one of the other things you say and you write is that you've come to believe that the culprit is public company governance, the system in which many different groups, all pursuing their own agendas, generate rules for how public companies ought to be managed. So we're talking about who gets to be director, how execs should be paid, in what ways companies ought to respond to climate change, are constantly accruing and building on one another until this obscure process generates towering structures that, like a great coral reef, can tear out the bottom of a boat. That's your words. Gillian Wolff, I want to get your words. Global equity strategist here at Bloomberg Intelligence. You monitor, follow, report, write on the public markets in and out for us every day here. The public company governance systems, and I even think about like throwing in these quarterly earning reports that are now maybe being questioned once again by the president and others. It seems to make a U.S. system, certainly our public markets, very transparent and kind of the gold standard for investors in the world.
It has, and I think that's one of the concerns that investors could have about switching to this semi-annual versus quarterly cycle of reporting. But one of the main critiques of that system is that companies have perhaps been too short-term in their goals, right? You have to hit these quarterly marks, and if we have a broader time period between reporting, they could focus a little bit more on longer term or more intermediate term goals. But when it comes to just equity market concentration, I think I completely agree that companies are staying private for much longer. And one thing we've spoken a bit extensively about in our writing is that the Mag 7 stocks, which have become these monoliths in the S&P 500, are themselves buying up a lot of these smaller companies that are staying up private for longer. So we saw that with even Alphabet and SpaceX. which was mentioned in the New York Times op-ed piece. We saw this with Alphabet purchasing Wiz for $32 billion recently this year, Microsoft investing $13 billion in OpenAI. So the idea that there's a lot of concentration in what's the Mag 7, we've joked and said that's really the Mag 700, because if you look under the hood, you're getting exposure to a lot of these smaller private names through the investments of the Mag 7, which have a ton of cash on hand right now. And they really have the opportunity to buy either fully these companies or decently sized stakes in these larger now private companies.
So, Bryce, does all this mean that, and there's been this movement, we've spoken to Vlad Tenev of Robinhood about this, like he's been this proponent of putting, making these companies, these private companies accessible to retail investors. Is that part of the answer here in your view?
It might be. I am an optimist, though.
Okay.
I think that we clearly have made some mistakes in our public markets to make them less desirable as places to be, and I think we can probably fix those mistakes and make public markets as compelling as they were in the 1980s and 1990s. If that proved to be impossible, then yes, I think there is going to have to be some way to give the average person some exposure to the private market. Otherwise, they're just missing too much of what's going on in the economy.
But I want to ask you, though, I mean, one of the things, and maybe Gillian come back in, because the main crux, too, is the public company governance. And so whether it's issues on climate change or who's on the board and so on, when you think about companies in your coverage, is that important?
It varies, right? So we've definitely seen some pushback on some of the ESG regulations, but there's definitely a lot of public focus on these public companies, right? From both a PR and regulatory standpoint. I think one of the benefits for companies that are private, let's say, that are willing to be taken fully under acquisition or have a majority stake taken under acquisition by one of these larger firms is they get access to their existing infrastructure to help deal with some of these regulations and some of these governance concerns. So if you're OpenAI, for instance, you're more willing to allow Microsoft to take a stake in you and leverage their existing internal structure to manage some of these governance issues rather than trying to build that out yourself. It's very hard now to go from public to private if you don't have those in-house resources.
Well, and it's interesting, Bryce, and come on back in here. I mean, ESG initially, and it really got warped and changed, I think it's safe to say, but it was, about governance issues and environmental issues that could financially, right, impact the company. And this is why companies need to pay attention. And so there is a reason why they're out there, these metrics, in terms of how it could impact actually a company's business. If you're an insurance company, climate change is impacting you. If you're, pick your industry. I mean, these things actually do come into play.
Yeah, you're absolutely right. I mean, ESG has always been a weird concept.
Yeah.
It was designed by law firms to be able to give legal advice to their investor clients that they could invest as fiduciaries using ESG. You always had two elements of ESG, the environmental and social element, which are focus on the outcomes for, non-shareholder constituencies, combined with the governance metric, the G in ESG, which is focused just on total shareholder return for the most part. So it was always a little contradictory. I think in response to your question, I would focus on the governance part, because that's the longest part. We've been living in an era of corporate governance since 1990s. That's the decade that the Economist magazine called the era of corporate governance. And since then, we have fiddled with corporate governance a little bit every year for the last, really almost 3 decades. And we now have an enormous body of empirical research looking at are the things that we're doing in corporate governance, do they produce better outcomes for companies? Do they make them more valuable? Do they fire underperforming CEOs better? Do they keep executive pay lower or more reasonable? Just what effects do they actually have that we might care about? And I've written an entire book summarizing this research, which can be stated simply as No, none of these rules do any of these things. And so they really wind up being either a waste of time or counterproductive. And so when you talk to managers about public markets, they do have a sense that this is interfering with running the companies the way they'd like to. It's expensive, it's cumbersome, and it's just not producing results that they or the shareholders should really care about.
We're speaking right now with Bryce Tingle. He's former regulator who's now the N. Murray Edwards Chair in Business Law at the University of Calgary. He's also the author of Hard Lessons in Corporate Governance. Also with us is Gillian Wolff, global equity strategist at Bloomberg Intelligence.
Thank you. I mean, one of the questions I wanted to ask you, Professor, was what you think the major regulations are that are actually holding these companies back. Is it this? Because there's a lot of talk right now about how changes should be made. Is it maybe less adherence to these ESG structures? Would actually switching to this semi-annual versus quarterly reporting structure help? Is it proxy voting? I mean, we've seen the rise of activist investors and boards getting spooked a little bit about random investors, hedge funds, large institutions now having a large say in how they run their business. If you could call out one or two major issues, what do you think they are right now that are really plaguing companies and the biggest concern for companies looking to go public?
So I will call out one or two, I think, of the bigger culprits. But I want to say that, I chose that metaphor of a coral reef that was referenced earlier in my New York Times essay deliberately, because I think individually, the changes we've made to corporate governance over the last 30 years, each individual little change by itself probably wouldn't make a great deal of difference. But like a coral reef, little changes can eventually produce a real hazard for navigation. And I think that's how I'd characterize our corporate governance regime. And not all of it is regulation. Not all of it is Sarbanes-Oxley or Dodd-Frank or something the SEC's done. Some of it just the actions of private parties or norms that have slipped into the market. We, for example, went from in the 1970s having boards that comprised large numbers of, maybe even majorities in some cases, of inside directors, to boards that had majority independent directors and then had supermajorities of independent directors and then had every director independent except the CEO. And that wasn't legislatively required. We did that under a theory that the only real contribution directors make is to monitor management. And that the best way to do that is if the directors don't know the CEO or aren't related to him or her in some way. And subsequent events have proven that, in fact, that doesn't work. Well, I'll give you a couple examples.
Well, I just want to jump in real quick because we only have 1 more minute, and I want to make sure to get to the compensation part of this, and that could be where you're going. But compensation is something that you highlight in your piece and the way that shifted. So just very briefly, how does compensation play into this? Because there are some pretty outsized salaries, I think critics would say.
Right. So what's interesting about compensation is it only really started to go up during this era of good corporate governance, starting in the 90s. Once Congress started making tax rules to try and affect the way we pay executives, once proxy advisors and institutional shareholders got into the mix, we wound up increasing the amount of equity exposure executives had. And we wound up also trying to pay for performance. And the effect of both of these things has been to massively increase the size of pay for executives. Pay for executives have been pretty flat for the 40 or 50 years following the Second World War in America. And then they just started increasing hugely in the 90s and aughts. And what's interesting to me anyways, is that when you look at all the different corporate governance things we did, from the best pay practices to the proxy advisors to say on pay voting, when you examine each one individually, you find they're associated with pay increases. And yet we kept trying them.
Yeah. I don't know. It's an interesting issue. We have to wrap up, but I want to do 20 seconds, say for you, Gillian. I mean, when you guys look at companies, do you look at pay packages of the CEO or the C-suite?
It's not a major factor that we look into, because ultimately when it comes down to the bottom line and the overall costs of expenses of these companies, it's not necessarily this C-suite pay that's really going to crush those bottom lines as a
Cost
result.
overall,
Right, but it's definitely an optics issue. I think more so if you have a CEO that's making $60 million, particularly if the stock is down that year, that's definitely a question that comes into the public mind. But it doesn't really make as much of a difference to how much money the company makes in the end.